You're watching Silver News Daily. Subscribe for more.
Which I suggest is mostly a whole bunch of to-do about nothing. I'm much longer oriented. And as always, I'm trying to figure out what's cheap and what's not cheap. And among those things that are cheap, those things that I understand. I look at the broad landscape as an example in the United States market. And despite the fact that I'm starting one, I think community banks are really cheap. Uh, People are pricing them as though other folks won't need banking services for the next 30 years, which is absolutely stupid. Uh, I think that there's a lot of indecision around the good, the bad, and the ugly among the uranium stocks, and people tend to value them the same, although there's vast differences between the companies. So I'm trying to take advantage of that. When I look at the investment landscape going forward, of course, all things change, but I'm struck by the similarities between the circumstances that confront us now and the circumstances that confronted an earlier generation in the decade of the 1970s. Incipient inflation and the lack of understanding about the way inflation impacts the purchasing power of one's savings, and the potential both to decimate the long bond market, decimate savings, and reward those investors who participate in alternatives.
Did you know that silver is poised to skyrocket in 2025, potentially reaching prices we haven't seen in decades? Sounds bold, right? But what if I told you it's not just because of industrial demand or its role as an investment asset, but the powerful combination of both? In this video, legendary investor Rick Rule explains why silver is about to become the hottest commodity on the planet and how you can position yourself before it's too late. Trust me, you don't want to miss this.
Some little banks that have consistently generated 15% plus after tax uh, returns on equity, and I see these banks selling at a discount to book. The idea that I can buy a well-run local franchise that's generating 15% after-tax return on equity, selling for 70 or 80% a book, is the same thing as as being able to buy 18, 19, 20% internal rate of return, and I'm attracted to that. Uh, some bank investors look at the great big banks, the too big to fail banks, and they look at the fact that because they have the implicit federal guarantee, that their cost of capital is very low. People are willing or stupid enough to deposit money in the big banks for no interest. Some little banks, including my own, are beginning to make some inroads on that. It's surprise, surprise. People, when they take the risk of depositing money, would like to get paid. It is a truism that the little banks can't compete with the big banks. It's a less known truism that the big banks can't compete with the little banks either, because the little banks have expertise in their region or have expertise in their industries that the big banks simply can't afford to have. But that's narrative. What really attracts me is businesses that have historically generated 15% plus after tax returns on equity. Franchise like that, management teams like that, selling at 70 or 80% of book. There will come a time when those banks will be bought at 2 or 2.5 times book, having increased book at 15% compounded for 6 or 7 years. um, that sounds like an awful lot of fun to me, and nobody cares.
Silver prices have been on a roller coaster ride, fluctuating between bullish spikes and bearish dips. But what's really driving this volatility? Let's start with the basics. Silver has spent much of the past year hovering between $29 and $32 an ounce, with $30.60 serving as a critical pivot point for traders. This narrow trading range might seem unremarkable at first glance, but look closer. and you'll see the groundwork being laid for a massive breakout. Why does this range matter? It reflects a tug-of-war between short-term market forces and long-term potential. On one side, we have economic headwinds like inflationary pressures and rising interest rates, which often weigh on silver's appeal. On the other, there's growing global uncertainty, from geopolitical tensions in regions like the Middle East and South Korea to fears of a slowing U.S. economy. These factors consistently bring investors back to silver as a safe haven. And let's not forget the Federal Reserve. Fed Chair Jerome Powell's recent speeches have traders hanging on every word, as they anticipate rate cuts that could dramatically shift market dynamics. If interest rates drop, we could see the U.S. dollar weaken, making silver even more attractive for international investors. Now, here's where things get even more interesting. Silver's price action isn't just about its role as a hedge against economic uncertainty. Industrial demand is surging. From solar panels to electric vehicles, silver is indispensable in a world moving toward greener energy solutions. And while these technologies drive demand higher, mining output hasn't kept pace, creating a perfect storm for a supply crunch. But what does all this mean for silver in the short term? Experts agree that the key lies in breaking above the $31.71 resistance level. If silver manages to do that, it could ignite a bullish rally. And here's the kicker. Rick Rule believes that this potential breakout is just the beginning, especially as the dual forces of industrial and investment demand converge. So, what's your take on silver's recent price trends? Are we on the verge of a breakout, or is the market still too tethered to short-term pressures? Share your thoughts in the comments, and let's dive deeper into what's fueling this tug-of-war as we explore silver's role as both an industrial powerhouse and a safe haven investment.
In fact, am. The gold mining sector is, I think, discounting what I see as 10 years of deterioration of the purchasing power of the US dollar. That's disguised because the US dollar is outperforming all the other currencies, which is to say that the US society, despite the fact it's very competitive, is losing the race to the bottom relative to the others. And so, perversely, while gold is very strong in currencies outside the US dollar, it's weak in the currency it's measured in. I think that'll change for reasons we can talk about later if you want to. But the gold mining industry is behaving rationally right now. They are rewarding companies that are performing, and they're penalizing companies that aren't. All-in sustaining costs are stubbornly high at both Barrick and Newmont. Cash margins have been less buoyant than one would expect, given the increase in the selling price of the commodity that they produce. Margins have been expanding at places like Agnico Eagle, and they have consistently beat guidance. The consequence of that is that while Newmont is down, Agnico Eagle is up. Surprise, surprise. A company that performs does well. A company that doesn't perform does poorly. Now, I happen to believe that the business plan at place at Newmont is an intelligent plan. I also believe it's going to take a year and a half to play out. If you are willing to bet that they can implement the plan, you could invest now in anticipation of the successful resolution of that plan. By the way, to save your listeners a bunch of reading, the plan is that Newmont, after the Newcrest acquisition, will sell basically all of their Tier 2 assets. They operate too many mines now, and their management time and attention and their sustaining capital budget is split between too many competing mouths. The idea that they would take advantage of a very buoyant property market, which we're in right now, to sell the Tier 2 assets, use the cash to pay down their debt, and focus management love, time, and attention, and also sustain.
Silver isn't just a shiny metal. It's a cornerstone of modern technology. From powering the latest generation of electric vehicles to enabling the transition to solar energy, silver's industrial uses are growing at a record pace. Let's dive into the specifics and uncover why this surge in demand is key to silver's future. First, consider the role of silver in renewable energy. Did you know that every solar panel you see depends on silver? It's used in photovoltaic cells to conduct electricity with unmatched efficiency. With global efforts to combat climate change ramping up, the demand for solar panels is expected to skyrocket. According to industry forecasts, solar energy capacity is set to triple by 2030, and silver demand is rising alongside it. Now, let's talk about electric vehicles, EVs. The automotive industry is in the midst of a revolution, with governments worldwide pushing for greener alternatives. EVs rely heavily on silver for components like batteries, charging stations, and onboard electronics. With major automakers like Tesla and General Motors planning to expand production significantly over the next 5 years, the need for silver is climbing at an unprecedented rate. And it doesn't stop there. Silver is also indispensable in high-tech industries. From 5G infrastructure to medical equipment, silver's superior conductivity and antibacterial properties make it a go-to material for cutting-edge innovations. For example, hospitals around the world are using silver-coated tools and surfaces to reduce infections, a trend that surged during the pandemic and shows no signs of slowing down. But here's the catch. While industrial demand is booming, global silver production isn't keeping pace. Mining operations are grappling with declining ore grades and geopolitical risks, particularly in major producing countries like Mexico and Peru. This imbalance between rising demand and constrained supply could be the spark that lights the fire under silver prices. Rick Rule has long emphasized that industrial demand acts as a foundation for silver's value. It's the steady undercurrent that keeps the market grounded, even during times of economic turbulence. Yet it's this very foundation that is now driving unprecedented pressure on supply chains. So here's the big question. How will the silver market balance this surging demand with its production challenges? And how might these trends shape the prices we see in 2025? Let us know your thoughts in the comments below as we continue exploring silver's unique dual role in shaping its future trajectory.
In a 5-year term. I don't attempt to trade it short term. As you suggest, there's so many variables that trying to understand the short-term market is trying to know the unknowable, which is a waste of time. But I like big math, Jesse. I like really, really, really big math. So let me give you some oil and gas big math. The price of U.S. natural gas, Henry Hub, is about $2 per million BTU right now. Canadian gas is even cheaper, $1.50 Canadian, about $1 US ACO. That same gas per million BTU landed at Rotterdam or Tokyo or Shanghai goes for 8.5, $9 US. Takes a couple bucks US to get it there. That arbitrage is too great to continue. And there are billions of dollars being spent every month to address that arbitrage. Gas storage, gas gathering, gas processing, gas transmission, liquefied natural gas, deliquification plants, tankers. When you have an arbitrage that broad, against a different arbitrage, which is the BTU arbitrage between oil and natural gas, the energy differential is about 6-to-1 per barrel against a million BTU, 1,000 cubic feet of gas. Gas is selling at more than a 50% discount to BTU dollar parity. So you have these two arbitrages, one, the gas to oil arbitrage, and the other, North American to Europe or North America to the Asia. Market inefficiencies in markets that are measured in the tens of billions of dollars. Market inefficiencies of that magnitude, a 60 or 65% gross selling price inefficiency, get arbitraged out. Will I be right in 2025? Almost certainly not. Will I be right by 2030? Absolutely, positively, without a doubt. I've told you before, Jesse, that I love questions where the answer begins with when, not if. And that's what natural gas is. And mercifully for me, most of my competitors, including some of the biggest investors in the world, invest with a long-term narrative, but they use a short-term tactic. In other words, they invest in something with a 5 or 6 year outcome, and they have trauma holding stock over a long weekend.
When uncertainty grips global markets, investors look for safety, and that's where silver truly shines. Beyond its industrial applications, silver has a long history as a hedge against economic instability, making it a vital part of any diversified portfolio. But why exactly is silver considered a go-to asset in turbulent times, and why is its investment demand soaring alongside industrial demand? First, let's talk about inflation. When currencies lose value, precious metals like silver gain it. Over the past 2 years, inflation rates in many advanced economies had hit multi-decade highs. While central banks have scrambled to rein it in, savvy investors have turned to silver as a way to preserve their wealth. Historically, silver has outperformed during periods of inflation, offering not just stability but also substantial returns. Now consider silver's unique affordability compared to gold. With gold trading at a premium, silver offers an accessible entry point for small-scale investors who want to hedge against market volatility. It's often referred to as the poor man's gold. But don't let that nickname fool you. Silver has the potential for higher percentage gains due to its smaller market size and growing demand. What makes silver even more compelling is its dual nature. While gold is primarily an investment vehicle, silver's industrial use creates a built-in demand floor. This means even when investor sentiment wanes, silver rarely falls out of favor entirely. For long-term investors, this dual role provides a sense of security that's hard to match. But it's not just retail investors driving the trend. Institutional investors are increasingly recognizing silver's potential. Exchange-traded funds, that's tied to silver, have seen record inflows, while central banks in emerging markets are reportedly eyeing silver as part of their reserve diversification strategies. And with geopolitical risks on the rise, silver is gaining traction as a globally recognized store of value. Rick Rule puts it best: silver thrives when fear and greed converge. Fear fuels the demand for safe haven assets during crises, while greed pushes speculative investors to chase the metal's upside potential. Right now, both forces are at play. With the global economy teetering between recovery and recession, silver stands out as a must-have asset for those looking to hedge their bets. Here's something to ponder. With inflation cooling but geopolitical tensions rising, will investment demand for silver outpace its industrial use in driving prices upward? Let us know what you think as we move closer to unpacking the perfect storm that could send silver prices soaring in 2025.
They're certainly cyclical stocks. If one owns them through the cycle, which I do, um, they perform extraordinarily well. In addition to that, people knock them because they're slow growing industries, which in fact they are. But they are both companies that have been reasonably successful at vertical integration, which is unusual. And they are companies that generally have, within a band, decent returns on capital employed. And because they're slow growing, they're usually kind enough to return uh, a fair bit of their income to shareholders by way of dividends, and those are in fact earned dividends. Investors in the space need to be very concerned about the outcome of a peaceful resolution in the dispute between Russia and the Ukraine. When the Russians come back into the phosphate market, they are the world's lowest cost producer. For a while, that's not going to be a problem because the Russians have deferred sustaining capital investments. It seems the Russians have had other uses for money. And if you defer sustaining capital investments, you impair your ability to produce in the out years. We saw the Russian potash industry take 5 years to recover from the reorganization of Russia in 1989, 1990, 1991, the last time that the Russian state needed money to the extent that it needs it today. So, assuming, first of all, that peace occurs in the Ukraine, which I hope happens, there will be a time when the Russians and their friends, the Belarusians, uh, retool their domestic industry, which will give the West some breathing room. When they retool in the potash industry, you need to understand that Russia can be the lowest cost and highest volume producer on the planet.
That's a great insight.
That would be my only caution. I think too
Yeah.
that 5 years from now, not immediately, but 5 years from now, the price of all nitrogenous components goes up. Natural gas is too cheap right now. It's produced as a byproduct of oil. The consequence of various technologies coming together with a very low cost of capital has meant that U.S. oil production, in particular, but Canadian oil production too, has surged, and byproduct gas production has surged. The BTU arbitrage between oil and gas is too high, and billions of dollars are being spent on monetizing that arbitrage. Over 5 years, that'll be successful, but it won't be successful in 2024, 2025, 2026. The bottom line of that is that natural gas prices will rise. The consequence of that is that nitrogenous fertilizer prices will rise, and that will impact all the way down to the farmer. He or she will have to pay more for nutrients, but the nutrient distributing companies will have to pay more for that input.
Silver's greatest strength lies in its versatility. It's not just an industrial workhorse or a safe haven asset. It's both. This dual role is what sets silver apart from other commodities, and it's the key to understanding why it's primed for an explosive price surge. But how do these two roles work together to create such a compelling investment opportunity? Let's start with the industrial side. As we discussed earlier, silver is essential in technologies like solar energy, electric vehicles, and high-tech medical equipment. This demand isn't going anywhere. In fact, it's accelerating. Every new solar farm, EV battery, and 5G network built adds to the global need for silver. This provides a steady, predictable baseline for demand, even when market conditions fluctuate. On the investment side, silver is a classic hedge against uncertainty. In times of economic turbulence, geopolitical instability, or inflationary pressure, silver becomes a beacon of safety for investors. What's remarkable is how these two forces, industrial demand and investment demand, often amplify each other. When economic instability drives up investment demand, industrial users often scramble to secure supply, fearing price spikes or shortages. This creates a feedback loop, pushing prices even higher. Consider this. During the 2020 market turmoil, silver prices surged by over 70% within a year as both investors and industries rushed to secure the metal. While some saw this as an anomaly, Rick Rule argues that this phenomenon is a preview of what's to come. As we edge closer to 2025, he predicts a convergence of industrial and investment demand that will drive silver prices to unprecedented levels. But why now? What's different about this moment? The answer lies in the perfect storm brewing in global markets. On one hand, we have rapid industrial expansion in renewable energy and technology, which keeps demand high. On the other, we're seeing a world fraught with economic and geopolitical risks, from inflationary pressures to potential recessions, making silver an increasingly attractive asset for investors. The real magic, however, is how these two dynamics reinforce each other. Industrial buyers can't afford to wait when prices rise. They need silver to keep production lines moving. At the same time, investors see rising industrial demand as a bullish signal and pile in, further tightening supply. Rick Rule describes silver as the best of both worlds, a commodity that thrives on growth and uncertainty alike. So the big question is, will 2025 be the year when these two forces finally converge to push silver prices to new heights? Let us know what you think in the comments below as we continue exploring the factors shaping silver's bright future.
A couple things. Buffett famously says, put all your eggs in one basket and watch that basket very closely. The truth is that Nevada's premium royalty is Northern Nevada. That doesn't suggest, by the way, that there aren't real political risks in the United States, but that's a very different question. What Franco-Nevada has managed to do mostly is concentrate on very, very, very high quality assets. They have come down the quality trail because they've been impatient. When the ability to attract high quality assets gets scarce, the temptation is to do something. For me, with regards to both Franco and Wheaton, what attracts me about them is that we are in a new era of mine finance, particularly in the copper space. And building a copper mine with gold and silver byproduct credits is an extremely expensive endeavor. If you are having to raise $8 billion, as an example, you need to utilize all aspects of the credit stack. Producer is valued at 6 times EBIT. That same cash flow, limited to gold or silver as a stream or a royalty in a precious metals company like Wheaton or Franco, is valued at 15 times EBIT. That's too great an arbitrage to ignore. This new cycle of mine finance, and separately, a cycle where sovereign governments in emerging markets want increasing equity shares in mines but can't pay for them, and could pay for them through the sale of a royalty or a stream to somebody like Franco or Wheaton, means that the companies with the financial means in the next 5 to 10 years are going to have the opportunity to deploy billions of dollars in tier one deposits that will generate free cash for 20 or 30 years. The knock on both Franco and Wheaton is, how do they grow? And the answer is right there in the market. The arbitrage between precious metals cash flows trapped in base metals producers or crystallized in a stream on behalf of a royalty and streamer is the difference between 5 or 6 times EBIT and 15 or 20 times EBIT.
Silver doesn't exist in a vacuum. Its price movements are deeply tied to the state of global affairs. To truly understand what could drive silver prices to skyrocket in 2025, we need to examine the geopolitical and economic forces at play. These factors act as a pressure cooker, intensifying both industrial and investment demand in ways that can trigger massive price shifts. First, let's address the elephant in the room: inflation. While inflation has started to cool in many advanced economies, the scars it left on global markets remain fresh. Central banks have only recently begun to ease monetary policy after years of aggressive rate hikes. The U.S. Federal Reserve, for instance, has hinted at potential rate cuts in the coming months, a move that could weaken the dollar and make silver more attractive to international buyers. But monetary policy isn't the only factor. Geopolitical tensions are creating waves that ripple across all commodity markets, including silver. In regions like the Middle East, ongoing conflicts threaten supply chains and fuel safe haven demand for precious metals. Similarly, political unrest in countries like South Korea and France adds to the uncertainty, making silver a go-to asset for those looking to hedge against potential economic fallout. Now consider silver's role in emerging markets. As industrial economies like China and India expand, their demand for silver rises, not just for technology and infrastructure, but also as a reserve asset. These nations are keenly aware of the vulnerabilities in fiat currencies and are increasingly turning to tangible assets like silver to stabilize their reserves. On top of that, we can't ignore the potential for supply disruptions. Many of the world's largest silver producers are in politically unstable regions, such as Mexico and Peru. Strikes, policy changes, or outright resource nationalization could limit production, tightening supply even further. For example, Rick Rule has pointed out how geopolitical risks in mining countries can act as a wild card, creating sudden supply shocks that send prices soaring. Another factor is the rising competition between nations for critical resources. The global shift towards renewable energy has nations scrambling to secure metals essential for their green energy goals. With silver playing a vital role in solar panels and EV, countries are increasingly treating it as a strategic asset. This adds another layer of demand that could intensify if trade disputes or geopolitical rivalries escalate. So, where does this leave us? We're standing at the crossroads of economic recalibration and geopolitical upheaval. These forces, combined with silver's dual role, are setting the stage for a dramatic shift in the market. The big question is, how will these drivers interact over the next 2 years, and could they create the perfect storm for silver prices to reach unprecedented levels?
Franco is fairly valued. It hasn't been fairly valued for a long time. It's a gift. Arithmetically, people invest in narrative, but they should invest in math. Arithmetically, Cobre Panama accounted for about 15% of Franco's net present value. And when the government of Panama took Cobre Panama, Franco's share price declined by 42%. So the disparity is between 15% and 42%. The second thing that somebody needs to consider is how much of this will Panama get away with? The nationalization of Cobre Panama abrogated sovereign contracts, and that still needs to be handled in arbitration. The realistic claim that the interest holders have, including First Quantum and Franco-Nevada, likely exceeds $10 billion US dollars. What might the Panamanians use for money? My belief is that that asset isn't gone for good, or if it is gone for good, the ultimate settlement between the Panamanians and the interest holders isn't factored in the market at all.
Emerging markets are rapidly becoming the silent drivers of silver's booming demand. These countries are not only growing their industrial footprints, but are also reshaping how commodities like silver are valued and utilized on the global stage. Let's dig into how these rising economies are setting the stage for a silver price explosion. First, let's talk about industrial demand. Emerging markets like India and China are investing heavily in renewable energy infrastructure. India, for instance, has ambitious plans to quadruple its solar energy capacity by 2030. This expansion requires massive amounts of silver for photovoltaic cells, making India one of the fastest-growing markets for silver consumption. Similarly, China's dominance in EV production and its ongoing push for green technologies are driving record-breaking demand for silver in manufacturing. But the story doesn't end with industrial uses. Emerging markets are also looking at silver as a financial asset. Unlike advanced economies that rely heavily on fiat currencies, many developing nations see tangible assets like silver as a hedge against currency volatility and inflation. Central banks in these regions have quietly been increasing their reserves, not just in gold but also in silver, as part of a broader strategy to stabilize their economies. Another key factor is urbanization. As populations in emerging markets migrate to cities, the demand for technology and infrastructure, both heavily reliant on silver, continues to surge. From 5G networks to medical equipment, these technologies are becoming essential components of urban life, and silver is at the heart of it all. Now, let's talk supply. Many emerging markets are also major silver producers, but political instability often disrupts mining operations. For example, countries like Peru and Mexico, which account for a significant portion of global silver production, have faced strikes, regulatory shifts, and even outright nationalization efforts. This creates a paradox where emerging markets drive demand while also facing constraints in supply, a scenario Rick Rule highlights as a critical factor for upward pressure on prices. Then there's the global race for green energy. As emerging markets expand their renewable energy capacities, they are competing with advanced economies for limited silver supplies. This competition could lead to higher prices as nations stockpile the metal to meet their energy goals. Rick Rule often emphasizes the role of emerging markets in creating tipping points for commodities. He sees their growing demand for silver as both an industrial necessity and a financial strategy, making them key players in the metal's future trajectory. So here's something to consider. With emerging markets increasing their demand for silver while simultaneously disrupting its supply, could they be the ultimate catalyst for the price surge we're expecting in 2025? Let us know your thoughts as we dive deeper into the technological innovations and strategies shaping silver's future.
Gaining capital on 5 or 6 assets that matter is a really good plan, but they have to do it. If they are successful in doing that, of course, the gross ounces that they produce will fall. That will happen. But the margins will expand. And the all-in sustaining capital costs will fall. The other thing that your listeners need to understand that is very difficult to understand is that the returns on capital employed in optimization are often double or triple the overall returns on capital employed in an operation. If a mine is put in production with an ROCE in the feasibility study of 20 or 25%, that's one thing. But after the mine is in production, when you're making smaller investments in optimization, retooling a mill, increasing the size of the haul trucks, increasing the size and efficiency of the shovels, return on capital employed in optimization can be 50%, 60%, 100%. Two, big mines are almost always put into production when there is enough reserve and resource to amortize the upfront capital expense. But those mines, in every case I'm aware of, deliver upside exploration surprises after near mine exploration commences, which is to say a mine with a 12-year mine life often produces for 18 years or 20 years. I look forward to Newmont benefiting from selling their Tier 2 deposits, improving their balance sheet, focusing their love, care, and attention on optimization, and expanding the mine lives in their Tier 1 operations. That plan will work if they implement it. It will be up to your listeners in terms of how their own portfolios do to monitor Newmont and Barrick's adherence to their plans.
Silver isn't just valuable because of its current applications. It's also a key to the future. Technological advancements across industries are unlocking new uses for silver, creating additional layers of demand that could send prices soaring. Let's explore how innovation is shaping silver's future and what this means for the market. First up, renewable energy. As the world transitions to greener power sources, silver remains indispensable. Solar panels, which already consume a significant portion of the world's silver supply, are becoming more efficient thanks to new technologies. Researchers are developing thinner and more conductive silver coatings, reducing material costs while increasing energy output. This innovation doesn't lower demand. Instead, it broadens the market as solar technology becomes more accessible globally. Then there's the electric vehicle EV revolution. Advances in battery technology are placing silver at the forefront of energy storage. Experimental designs incorporating silver for enhanced conductivity and thermal stability are showing promise in extending battery life and charging efficiency. As EV adoption continues to rise, these innovations could drastically increase silver's industrial use. But it's not just renewable energy and EV. Silver is making waves in cutting-edge tech sectors. For example, the rollout of 5G networks relies heavily on silver for its unmatched conductivity. Silver nanoparticles are also being used in high-tech medical equipment and antimicrobial applications. Hospitals are investing in silver-coated instruments and surfaces to reduce infections, and this trend is accelerating with advancements in nanotechnology. Now, let's look at mining. The supply side of the equation is also seeing innovation. Companies are exploring new methods to extract silver more efficiently from lower-grade ores. Technologies like bioleaching and advanced ore sorting are showing promise in reducing costs and increasing yields. However, these methods are not yet widespread, meaning supply constraints could persist even as demand rises. Rick Rule frequently points out that technological breakthroughs often have a compounding effect on commodity markets. As new applications emerge, they create a feedback loop of demand, drawing more attention from both industrial users and investors. For silver, this means that each new innovation adds another layer of scarcity and value. The real question is, how quickly can these technologies scale, and will they keep pace with skyrocketing demand? With silver playing a critical role in nearly every future-forward industry, from clean energy to advanced medicine, it's clear that innovation is a driving force behind its rising value. So, what do you think? Are these advancements enough to push silver into a new era of dominance? Drop your thoughts in the comments as we move closer to unraveling the perfect storm set to propel silver prices in 2025.
Nope. Nope. I'm a credit guy. I love, I think the worst piece of debt is better than the best piece of equity on any individual balance sheet. But I don't like the direction of interest rates, and I don't like duration. I own, relative to most people, a lot of U.S. Treasuries, and I don't own a duration longer than 2 years. The interest rate curve between the short and the long is stupidly disproportionate in terms of risk. And the part of the credit market that I've specialized in most of my life, which is below investment grade, is insanely overpriced. People have chased yield without any understanding of the covenants and conditions on the bonds that have been issued. Wall Street has unleashed a torrent, trillions of dollars of debt that is junk debt in the truest sense of the word. I remember the junk debt market, the below investment debt market in Canadian oil and gas companies in 1988, 1989, 1990, 1991. You could buy bonds with a cover yield of 12% that was being earned, and you could buy those bonds, 4 or 5 year bonds, at 60% of par, which meant that you had an 18% running yield and a 25% yield to maturity. And the bonds were covered by net present value in the first instance and by free cash flow in the other circumstance. You don't see that in the high yield market anymore. You don't see it in a market that I'm familiar with. I would point out something else to you, Jesse. The credit market, the yield market, is driven by a desperation for yield. And I think the yields are actually negative. People who buy bonds believe that a deterioration of the purchasing power of the US dollar is a function of the CPI, which is to say the bogey is 2.6%. I think the CPI understates the deterioration of the purchasing power of the US dollar substantially. When I look at the basket of goods and services that I buy, Jesse, I would suggest that the deterioration of purchasing power of the US dollar is more like 7.5%. I'm not.
To understand where silver is headed, we need to look at where it's been. And who better to guide us than Rick Rule, a legend in the world of mining and commodities. Rule's historical perspective on silver offers invaluable insights into how past market dynamics could shape the explosive potential we're seeing for 2025. Rick Rule often draws comparisons between today's silver market and the dramatic price surges of the past. Take, for instance, the 1970s, a decade marked by economic uncertainty, rising inflation, and geopolitical turmoil. Sound familiar? During that period, silver prices skyrocketed, reaching what would today be equivalent to over $100 an ounce when adjusted for inflation. Rule sees a similar alignment of factors today: persistent inflationary pressures, geopolitical instability, and rising industrial demand. What's particularly striking about rules analysis is his emphasis on market cycles. He's pointed out time and again that commodities, including silver, move in long-term cycles driven by shifts in supply and demand. Right now, we're at a critical inflection point. After years of underinvestment in mining, supply is constrained, while demand from both industrial and investment sectors is surging. According to Rule, these are the exact conditions that had historically preceded silver booms. Let's not forget silver's unique role during financial crises. In 2008, as global markets reeled from the financial meltdowns, silver prices nearly doubled within a year. Rule explains this as the fear factor when traditional assets lose their appeal, investors flock to safe haven metals like silver. The parallels to today's economic uncertainties, from inflation to potential recessions, are hard to ignore. Another key element of Rule's historical perspective is his focus on silver's underdog status. Unlike gold, which often dominates the spotlight, silver tends to fly under the radar until it doesn't. Rule argues that this stealth factor often leads to more dramatic price movements when the market finally catches on. He described silver as gold on steroids, capable of delivering higher percentage gains during bull markets due to its smaller market size and dual demand. But it's not just about history repeating itself. It's also about lessons learned. Rule has emphasized that understanding silver's past cycles can help investors anticipate future movements. For instance, he notes that silver's industrial demand has become far more robust in recent years, creating a demand floor that didn't exist in previous decades. This makes today's market conditions even more bullish than those of the past. So, what's the takeaway from Rule's analysis? The convergence of industrial and investment demand, coupled with the lessons of past silver booms, suggests that we're on the brink of something extraordinary. Rule's track record speaks for itself, and his predictions point to a future where silver plays a pivotal role in both the global economy and individual investment strategies. What do you think? Are we seeing history in the making? Or is this just another cycle in the silver market? Let us know in the comments as we delve deeper into what could make 2025 a defining year for silver.
Like Howard Marks' remarks a lot because they coincide with the way I think. I know a lot about natural resources, and I know a lot about conventional financial services, insurance businesses, banking businesses, agency businesses, and I don't know very much about anything else. So, like Howard Marks, I have no idea if tech stocks are overvalued. Uh, I don't know how to do net present value calculations on businesses that are growing quickly but don't make any money. I don't know how to analyze consumer durable businesses or entertainment businesses. I believe that the cost of capital will go up. I believe that the market would like to take interest rates higher, although the big thinkers would like to take it lower. So I'm cautious. And I take Buffett at his word. Buffett said he wasn't building cash as a tactic. He was building cash because some of the businesses in his portfolio were, by his measure, overvalued or fairly valued, and he couldn't find other places to put the money. He sees himself as being opportunity constrained. Now that may be a market call. He's pretty good. Yes, he's invested what for him is pocket change, $250 million in Domino's Pizza. But pretty obviously, when you're coming off, I don't know, $100 billion worth of sales of Bank of America or Apple, you can't put all that money in Domino's. And I think he is finding a difficulty in investing in companies with some sort of moat that have good margins, that are big enough for him to participate in. It's interesting when I look at his criterion, the industry that stands out to me, he's been a big investor in, which is to say the oil and gas industry. It may be that I'm falling for my own bias in that I'm attracted to the oil and gas industry. It may be that there's something in the out years that he sees in the oil and gas industry that I don't. But when I look at intelligent balance sheets, high margins, return on capital employed, I notice that the industry as a whole is not making sustaining capital investments, which is problematic. If you don't invest cash flow now, your means to generate cash flow in the future gets constrained. But there are companies in the sector that are making the sustaining capital investments and the new project investments while simultaneously rewarding shareholders. It's a mystery to me, and frankly, a concern to me, that Mr. Buffett isn't devoting more of his portfolio to oil and gas. It makes me wonder what he knows that I don't know. Maybe, unlikely. I know more about oil and gas than he does. He has focused on a lot of industries. I've focused on 3. But I'm concerned about the fact that an industry that meets his criterion so specifically, where he's already invested, isn't capturing a larger part of his wallet share.
2025 is shaping up to be a pivotal year for silver, a year where all the forces we've discussed so far could align to create an unprecedented price surge. But what are the specific catalysts that make this year so critical, and how could they drive silver to new heights? First, let's look at the macroeconomic landscape. By 2025, the Federal Reserve is widely expected to have eased its aggressive rate hiking cycle, possibly transitioning to rate cuts. This shift would weaken the U.S. dollar, making silver more affordable for international buyers and boosting demand. Historically, silver has thrived in such environments, and this time could be no different. Second, industrial demand is set to reach record levels. Global commitments to renewable energy, including massive solar and wind projects, will hit key milestones by 2025. Countries are ramping up their green energy goals, and silver's role in photovoltaic cells and battery technologies ensures it will be front and center. Combine this with the surging EV market and the rollout of 5G networks, and you have an industrial demand surge like no other. Now consider supply-side constraints. Many of the world's top silver-producing regions are grappling with challenges such as declining ore grades, regulatory changes, and geopolitical instability. This supply bottleneck, coupled with skyrocketing demand, could create the perfect storm for a price breakout. Geopolitical tensions could also play a significant role. The ongoing rivalry between major global powers, trade wars, and resource nationalism are driving nations to secure critical metals like silver. Stockpiling by governments and industries alike could further tighten the market. And then there's the speculative frenzy. Rick Rule has often highlighted how silver markets are prone to sudden, explosive moves once investor sentiment shifts. By 2025, the combination of industrial and investment demand could trigger a wave of speculative buying, amplifying price gains. ETFs, futures, and physical silver markets could see massive inflows as institutional and retail investors alike rush to capitalize on the metal's momentum. Finally, 2025 could mark the year when technological innovations begin to mature, further boosting silver's appeal. Advances in recycling and mining technologies might help alleviate supply concerns, but not before demand outpaces availability, driving prices upward. So what does this all mean? The convergence of monetary policy shifts, industrial growth, geopolitical factors, and speculative interest makes 2025 a year to watch. Rick Rule's prediction suggests that these combined forces could propel silver to heights we've never seen before. The question is, will you be ready to take advantage of this opportunity? Let us know your thoughts and strategies in the comments below. And stay tuned as we move closer to unraveling the apex of this incredible silver story.
It's entirely a function of how hard that investor wants to work and what their tolerance for loss is. Jesse, at the beginning of my investment career, I was insanely speculative. But let's put that in context. I was co-owner of the most popular bar in Vancouver, a bar that was frequented by Murray Pezim, Adolph Lundin, Billy Rand, Peter Brown. And I literally, not figuratively, literally would pour these guys drinks and ask them questions. Run back in the back, write down the answers, come back, pour them more drinks, ask them more questions. I worked very hard. I had great access to information. I was present at tables where deals and transactions were taking place. Not that I traded on material non-public information, of course. Uh, Suffice it to say, I had a definable competitive advantage and I worked very hard. And because I owned that bar and I had dependable free cash flow, and because I had invested in a couple of triplexes where my cost of capital was fixed, but my return on capital employed continued to increase, I could afford to be extremely aggressive. And I was extremely aggressive. All of the money that I now invest carefully, I made by speculating wildly. But I worked hard, Jesse. I had advantages. Somebody who lives in Vancouver, somebody who is willing to go up to Ross Beatty when he's at Tim Horton and ask him a question over coffee. Someone who reads insider reports, who reads resource calculations, who reads PEAs. That person should be aggressive. That person should be very aggressive. A smart, hardworking person who knows the difference between volatility, cyclicality, and risk, who lives in Vancouver, who can participate in private placements. There's just no excuse for that person to make $1 million in the next 5 years. But remember all of the classifications, all the categories. That same person, if he or she lives in Omaha and isn't willing to work hard, that person needs to be involved in beta, not alpha.
For investors, silver isn't just another commodity. It's an opportunity, a hedge, and a strategic play all rolled into one. But as we approach 2025, the stakes are rising. Understanding silver's dual role, its market dynamics, and its price drivers is essential to making the most of what could be a historic rally. So what should investors focus on? First, let's talk about timing. Silver is currently trading within a narrow range, but the signs of an impending breakout are clear. Technical analysts point to key resistance levels, such as $31.71, as potential triggers for a bullish rally. If these levels are breached, the momentum could carry prices significantly higher. Investors who act early could position themselves to benefit from this surge. Next, diversification is key. Rick Rule has often emphasized the importance of balancing risk and reward. Physical silver, whether in coins or bars, remains a staple for long-term investors looking to hedge against economic uncertainty. But ETF and mining stocks offer additional upside potential to those willing to take on more risk. Rule advises a mix of these options to create a well-rounded silver portfolio. Speaking of mining stocks, don't overlook the producers. Companies with strong fundamentals, efficient operations, and exposure to rising silver prices could see exponential gains. Look for miners operating in stable jurisdictions with proven reserves. Junior miners, while riskier, offer outsized returns if their projects succeed. Something Rule has highlighted as a high-reward play for seasoned investors. Then there's the role of silver in a diversified portfolio. Silver not only acts as a hedge against inflation, but also offers unique advantages over gold due to its industrial applications. This dual utility means silver can perform well in both risk-on and risk-off environments, making it a versatile addition to any investment strategy. One emerging trend is the increasing use of silver as collateral in financial transactions. As Rick Rule has pointed out, institutions are starting to recognize silver's value as a tangible, liquid asset. This shift could bring more institutional capital into the silver market, further driving demand. But what about the risks? Investors need to be mindful of short-term volatility, geopolitical disruptions, and potential oversupply from technological advances in mining. However, these risks are dwarfed by the long-term potential silver offers, particularly as we head toward 2025. Rick Rule's advice is clear. Approach silver with a strategic mindset. Whether you're a seasoned investor or new to commodities, now is the time to educate yourself, analyze your options, and build your portfolio. The next 2 years could be a game changer. So, are you prepared to take advantage of silver's unique position in the market? What's your strategy for capitalizing on this opportunity? Share your plans in the comments below as we gear up for the final step, the ultimate conclusion to this silver story.
We have, over 40 years, spent $5 trillion on alternative energy power generation. By the way, I've invested in alternative energies for years, sometimes successfully, sometimes not. That doesn't matter. We've invested in alternative energy generation for 40 years, almost $5 trillion. That $5 trillion investment has reduced the market share of carbon-based energy from a high of 82% to a low today of 81%. Now, I can understand how Mr. Trudeau would have a problem with that math. He's waiting for his budget to balance itself. But my suspicion is that given the fact that oil and gas is the generator of all of the transfer payments from Alberta, where Canada's money is earned, to Quebec, where Canada's money is spent, that even the Quebec electorate is more numerate than the Prime Minister. There's more math, too. I do like to take him on in math because, as I say, he's easier to like than I am. When he says there's no business case for Canadian natural gas, Canadian natural gas sells at AECO for $1.50 Canadian per million BTU. In Canadian dollar terms, it sells for $12 a million BTU. Frankfurt, Rotterdam, Shanghai, Tokyo, and it costs about 2.5 Canadian bucks to get it from southern Alberta to those markets. Transport, liquefaction, deliquefaction. So landed 4.5 Canadian bucks, it sells for 12 Canadian bucks. And there's eager buyers. And he doesn't see the business case. I do.
Everything we've discussed, industrial demand, investment appeal, technological advancements, and geopolitical tensions, points to one conclusion. Silver is on the verge of a historic breakout. By 2025, the convergence of these factors could create a perfect storm, propelling silver prices to levels we've never seen before. But how exactly does this happen? Let's bring it all together. Industrial demand is growing at an unprecedented rate, fueled by the global transition to renewable energy and advanced technologies like electric vehicles and 5G. This alone provides a steady foundation for silver's value, ensuring a consistent need for the metal regardless of market conditions. On the other hand, silver's role as a safe haven investment is gaining traction as economic uncertainties and inflation fears continue to loom. When these two forces, industrial and investment demand, merge, they amplify each other, creating upward pressure on prices that's hard to contain. Now add the constraints on supply. Mining production is struggling to keep up with rising demand due to declining ore grades and political instability in key producing regions. This imbalance between supply and demand tightens the market further, setting the stage for explosive price growth. Geopolitical tensions and shifting monetary policies act as the final accelerants. As nations race to secure critical resources, silver becomes not just a commodity but a strategic asset. Central banks and institutional investors are already taking notice, and by 2025, we could see a tidal wave of capital flooding into silver markets. Rick Rule has said it best: silver thrives in moments of convergence, where fear, greed, and necessity collide. That moment is upon us. The forces we've analyzed throughout this discussion are not independent. They're interconnected, and together, They're creating a scenario that could see silver prices skyrocket. But what does this mean for you? The opportunity to position yourself is now. Whether it's physical silver, mining stocks, or ETFs, having exposure to silver could be the move that defines your portfolio in the years to come. The market is primed, the conditions are aligning, and 2025 could very well be a year that silver claims its rightful place as the most sought-after commodity on the planet. So, are you ready to take the leap? Let us know how you're preparing for this unprecedented opportunity in the comments below. And don't forget to subscribe for more insights like this to stay ahead of the curve. This is not financial advice, but one thing is clear. Silver's moment is coming, and it's closer than you think. So, are you prepared to take advantage of silver's unique position in the market? What's your strategy for capitalizing on this opportunity? Share your plans in the comments below as we gear up for the final step, the ultimate conclusion to this silver story.
And dumber than our presidents. That takes really special skill. He seems to believe that he's bigger than a market. And again, let's look at the arithmetic. I don't want to attack him based on narrative. He's better at narrative than I am. He's pretty, young, slender. I'm old, fat, bald. But I'm good at math. So let's look at carbon first of all, okay? And let's look at alternative energies. With regards to carbon, first of all, the emerging market nations say that carbon shouldn't be measured by nation. It should be measured by per capita. So the fact that the Chinese produce 50% more carbon than the United States does is a function of the fact that they have 4 times as many people. With India, the situation is more stark. Furthermore, and by the way, I think they're right. I think if you're going to penalize people per carbon, you have to look at people as being the same, irrespective of their nationality, which means that all of the cost has to be borne by the West. A second circumstance is that emerging and frontier nations, call them the global South, suggest that current carbon loadings are 2% of the problem, that 98% of the problems are historic loadings. And those historic loadings are all the property of the West. So if you are going to impose the carbon agenda, understand that all of the costs of carbon are going to be borne by the West. Now, to take a look at the impact of that, one needs to look no further than Germany, where power prices have quintupled and where they are literally now having to tear down wind farms to expand coal mines. What about alternative energies? Your prime minister will say. I would point out to him, first of all, that in northern climates, the sun doesn't shine much. And the idea that you rely on solar energy when for half the year the sun doesn't shine very much is arithmetically challenged.